How to manage finances in a business. Hi, my name is Kimberly Ann, and I am going to tell you about managing finances. Managing a business's finances is crucial because you need to know how much cash you need to make tax payments and monthly expenses. To manage your business's finances, you need understanding and skills in budgeting, cash flow management, creating a balance sheet and profit and loss statement, as well as accounting. This is what we are going to be discussing in the video. How to create a budget for a business. Cash flow management. Profit and loss statement. What the purpose of the balance sheet is. Importance of accounting. I will also be discussing 7 additional tips for how to manage finances in a business. How to create a budget for a business. A budget estimates the amount of income and expenses that your business has for a specific time. A business needs to have a budget to know how much it needs to fund its current commitments and know how much it will require in the future. Your starting point is to make a list of all expected monthly income sources, such as sales of products, affiliate marketing income, advertising revenue or consulting income. Then make a list of monthly expenses incurred, such as inventory costs, direct labor costs, website hosting, marketing costs, internet costs, taxes. You will also have to separate fixed costs from variable costs. A fixed cost remains constant for an extended period, such as rental costs or Wi-Fi. These costs are the same value every month. A variable cost changes in proportion to the level of activity, and you calculate it by taking the quantity of output and multiplying it by the variable cost per unit. An example is when you decide to pay a freelancer, and they charge you $20 per hour, and they spend 10 hours. The variable cost will be $200. You can have a short-term and a long-term budget. A short-term budget is for 12 months or less. And a long-term budget is for more than 12 months and can be for 3, 5, or 10 years. You include the income and costs onto a timeline to assess how much you will need. The inputs you should consider are recurring and non-recurring costs and expected costs incurred in the future. Here is an example. Let us look at cash flow management. Many businesses fail because of bad management of cash flow. Therefore, good cash management is critical to the success of your business. A lack of cash is one of the many reasons why most companies fail. Managing your money well is very difficult at the early stages of your business, especially if you have a seasonal business. A cash flow statement shows the amount of cash inflows and cash outflows. It includes cash flow from financing, operating, and investing activities. Cash inflows are money that has been received into your bank account or petty cash account. Usually, this is income from sales of products or services. Cash outflow is money that has been taken out of your bank account or petty cash account. This is generally in the form of expenses such as purchases of assets, repayment of loans, payments to suppliers, interest expense. You can track it monthly, quarterly, or annually. You aim to have a positive cash flow. This is when your cash inflow exceeds your cash outflow. Part of good cash flow management is making sure that you are getting paid because you will not have enough cash if you are not getting cash inflow. Late payments can cripple your cash flow. Have payment policies for your customers, and send them to your customers. Invoice your customers as soon as they are able, and follow up on invoices or late payments. The profit and loss statement. A profit and loss statement summarizes the business's profits within a specific time, whether it is monthly, quarterly, or annually. It shows the revenue and expenses that occurred and indicates the ability of the company to generate profits. It is essential for investors, obtaining working capital and a business loan. The structure is as follows. What the purpose of the balance sheet is. A balance sheet shows the financial standing of a business. A balance sheet includes the assets, liabilities, and equity of a company. Your business is doing well if your assets exceed your liabilities. It is essential because it is the foundation of managing your business's finances. An asset is what the business owns and results in an inflow income or benefits into your business. For example, a vehicle is an asset because you can use it to get to customers from who you obtain a payment. And inventory is an asset because there will be a flow of income when you sell it. A liability is what the business owes and results in the outflow of income or benefits from your company. Examples are suppliers that you will have to pay or a loan repayment. Equity is the funds that the owners have invested in the business. On your balance sheet, you differentiate between short-term and long-term assets and liabilities. A short-term asset and liability is one that you will have for 12 months or less, and a long-term asset and liability is one that you will have for more than 12 months. You should aim to have a positive net asset value or net worth, which is when the assets exceed the liabilities. The importance of accounting. Accounting is recording the transactions that happen in the business and summarizing the business's operations, financial position, and cash flows. It is essential because it keeps track of income and expenses, assets, and liabilities. It also ensures statutory compliance, and provides investors, and management, with information that can be used to make business decisions. External auditors audit the accounting records, and tax authorities might want your accounting records to ensure that you are paying the full and correct amount of tax. There is a lot of accounting software that you can use, such as QuickBooks, Xero, or FreeAgent. Lastly, let us discuss 7 additional tips for how to manage finances in a business. 1. Register your business and have a separate bank account. You should have a separate bank account for your business and register your business. You should separate personal finances from your business's finances. Even if you are making money from YouTube, you can decide to register your channel as a business because companies pay less tax than individuals. Therefore, you will have more income at the end after paying tax to the tax authorities. It is sensible to have a separate business account to track your monthly income and expenses properly, and you do not want to have audits on your personal bank account. 2. Have an emergency fund. It is a good idea that before starting a business and finalizing your budget, you multiply the budgeted amount by 5 or 6, and this amount be used as your emergency fund to cover yourself and your business in case your business is not successful. Every business should have an emergency fund and not use up all of the cash flows in case it struggles to earn enough income for some months. The problem is that the amount of expenses you incur is independent of the revenue you obtain. So even if you do not get paid by your customer, your creditors will still want to get paid. An emergency fund is vital for some months when the business is slower and unplanned expenses happen. You should always ensure that you replenish the fund as you use it afterward to not drop down to zero. 3. Hire professionals when needed. If you have a small or online business, it is not necessary to hire a full-time accountant. You can have a part-time or have a contractual accountant who can help you to identify tax deductions and savings. 4. Set aside money for tax season. Ensure that you have good record keeping and save all of the invoices and receipts for tax purposes. Also, set additional money on the side in case you need to pay extra tax. Not paying the entire tax amount or paying late will result in penalties, and interest payments is more cash outflow from your business. Aim to set aside at least 35% of income for tax purposes. 5. Decrease unnecessary spending. Reduce the amount spent on office supplies or sign a contract with a service provider for lower internet expenses. Also, travel to customers when necessary, and avoid too many client meetings at expensive restaurants. 6. Negotiate with suppliers. If you are selling products and are struggling to receive payments from customers, consider approaching your suppliers and arranging longer payment terms with them. Also, ask for discounts for some products and earlier settlement discounts. And, negotiate to make bulk purchases at a lower price. 7. Have different income streams. Consider obtaining income from different income streams, especially if you are making money online, so that if there is not a lot of money received from one source, you can obtain income from another source and have a higher chance of getting more money than depending on one source of income. There are many things to consider to help you to manage your business's finances effectively. It will take some time to understand and apply what has been spoken about. Managing finances is critical to a business's success, even if it makes a lot of money. There are templates online that can also help you. Check them out. However, if you are struggling a lot to manage the business's finances, then I suggest that you hire an accountant who will focus on your business's finances so that you can only focus on making money.